Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the box trading strategy, a method that has transformed how traders approach the market. You will discover how to identify these trading boxes, understand their psychology, and use them to spot high possibility trade setup. This strategy removes the complexity from price action and gives you a clear framework for your entries and exits. By the end of this video, you would understand exactly how to implement this strategy in your daily trading routine. Now, what is the box trading? The box trading is a systematic approach to reading the market structure through clear defined zones where price move between two parallel levels. This is Think of these zones as container that holds price or that holds price movement. The top of the box is also can be called a resistance point, while the bottom serves as the support. When you spot this box following on your chart, you are essentially identifying areas where buyers and sellers are controlling for power. This box, I've already marked them out on the chart. These are areas where buyers and sellers are controlling for power. The price is going up and down in a sideways movement. So these are what the box are. The beauty of the box lies in the simplicity. You will notice that price tends to bounce between these lines multiple times, creating predictable patterns. These box are formed because large institutional traders often place their orders in similar levels or similar price points, creating natural barrier that price respects. Now, when trading from this box, you are looking for price to test this level at least twice. The more times price touch this level, the more significant this become. This repetitive behavior creates opportunities for you to enter trades with clear defined risks. Like when price comes to this area, if I extend this box, you can see that price came to this area and it touched it multiple times before it went the opposite direction, even if it didn't go for a long time. Just get the basics of the trading strategy. See this box area, I extended it, price came back to this area and it touched it and it reacted from this area. Same with this, when we extend it, we see price touched it multiple times, it wicked it at this area, wicked it before it reacted, before it eventually broke the area. Now let's know how we can trade with this box strategy. First, we will explore the Tokyo strategy, followed by the traditional box trading strategy. Now, the Tokyo block strategy is formed between the timing of the Asian section. This is specific time window. This specific time window creates unique opportunities because this is how Japan traders operate in the market. Now I would explain using the Asian range. I would like to use the Asian range indicator to help me mark out these zones. The Asian range indicator has already marked out these zones. When trading the Tokyo box strategy, you will notice that price tends to accumulate within a particular period. Between some period in the Tokyo range, you will notice that price has accumulated in such an area. Look at, it's moving in a sideways area. Price here is moving in a sideways movement in this area too, and in this area too. When trading the Tokyo box, you will notice price tends to accumulate within this specific period. Your task is to wait for the London session trader to trigger these accumulation positions. Now let's see how we can enter our trade. First of all, if you want to enter our trade using this Tokyo box strategy, we will first mark out the highest and lowest point within the Tokyo section. That's using this tool already, it has already marked it out for me. Secondly, we place our buy stop slightly above the range in case of a buy, and a sell stop just below the box just in case of it is a selling opportunity. Now let's practice this live. Under this box I would set my sell stop, put my stop loss above the high, then allow price to run into my sell stop and allow the momentum to take me to my take profit. This strategy is a very easy strategy. You just need to know the concept. Now let's talk about the traditional box. The traditional box are areas where you see price consolidating. When you notice price are consolidating or price is consolidating in a particular area, you mark them out. This box formed by price creating clear support and resistance levels across the time frame. So this, like I said before, the up part of the box should be the resistance or the support area. If price breakthrough is called the support. If price is reacting from under and it cannot pass this area, you know that this is called the resistance area, while the support is beneath. All we have to do is this box, we just have to notice that this box represents institutional order blocks and where market major players are actively participating in the market. How do we enter such area? We enter such area firstly by waiting for at least two tests of both the support and the resistance level. If we extend this, we would notice that price has tested this area multiple times. When we notice price have tested this area, we would enter once price breaks out from any of the area with a confirmation. Once price break out, you will enter. You can look for a pullback. Since price broke out here, you can look for a pullback to this area. Or let's use this example. When price broke out from this traditional box, it broke out and it pulled back to that area. We are always looking for a pullback to the previous box level for a better entry. All we need to do is enter at the area. If it's a sell position, you enter at the lower area of the box. You can use an anticipation method. You allow price to tap you in, or you allow price to take you in if you are anticipating the break of such area through your market context. Your market trend is your, remember, trend is your friend. You would have to analyze the trend of the market before, in fact you must know the structure of the market before considering trading any strategy, because the direction of the market helps you to get precise entry and to be at the right side of the market multiple times. Now the exit rule for such strategy is easy. You just need to target your 1:2, or you can be systematic. You can trail your stops. When you notice price is going in your direction, when price has entered and is going in your direction, you can decide to trail your stop level as price progress in your favor, or you can exit at a newly formed box. When you notice price start to move sideways, you can exit at such area, or you can take partial profit at the next box area. If you notice that there is a next box to your left hand side, you can take profit towards that area. I hope we understand what we are saying. Remember, these box work exceptionally well on JPP pairs for the Tokyo box strategy. That means if we are using the Asian or the Tokyo box strategy, we would have to trade pairs that have JPP currency attached to them, like the USD JPY, the Euro JPY. These are the currency pairs that we need to trade using the Tokyo box strategy. While the traditional box can be traded on any major pair. We can trade using the traditional box strategy on any pair of your choosing. This advanced concept requires practice to master. You can start by identifying these patterns on your demo account before implementing them on live accounts. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you will not miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.